Good afternoon, friends. All of you, I presume, have got the M&M quarterly as well as the annual results in hand, which were approved by the board today. Here I have got Mr. Parthasarathy, the President of the Finance Accounts IT Functions. We have Dr. Pawan Goenka, the President of AFS. We have Anand here too, so that at the end, when the question and answer start, you could start with him. Don't want to waste more time, so the order would be Partha will start first, then Pawan will give the detailed presentation on AFS, and then we will have some remarks from Anand, and then question answer. Partha.
Thank you, Bharat, and a very warm welcome to all of you for this edition of the Analyst Conference. This is my first on this side of the table, so and I'm sure you are very excited by the results and have a lot of questions, but let me first give you a quick overview. I'm going to talk about the interesting times that we have, our financial, and how I think we fared, and then hope in the question answers we convince you that we did, and what drives us. First, about the interesting times, and this is about a couple of weeks back, I was offering, before my son went to his 10th standard, a trip to Disneyland. And he told me, Dad, I may enjoy it, but you certainly won't enjoy it. Because you are having the roller coaster drives, the bungee jumps, the falling off the cliff every day in these interesting times that you will not find the Disneyland any good. So I think we are living in good times and interesting times. The euro crisis is threatening to destabilize this. More importantly, China on one hand slowing exports, and therefore the surplus, which has come to about 2.8% of GDP in 2011. On the other hand, their own economy, for stopping the heating up, the stimulus package is not in place. So therefore, economies like Australia, South America are getting affected. So China is looking at, in a sense, the dims global prospects. US on one hand has very good house tax, and that is very good for the economy. However, the unemployment rates which came out for a couple of months were not very promising, and therefore the quantitative easing, the next round of quantitative easing, seems to be a little bit in terms of when it's going to happen, how it's going to happen. So there is no linear growth which is assured. In India, we can sum up very quickly that if others won't do it to us, we will do it to ourselves. So the financial market has been subdued, and you all have seen it. Liquidity, we still have about 100,000 crores, which is short in the economy, and those also are chasing good customers, and therefore there is a huge amount of volatility in terms of the liquidity crunch. Coming to volatility, the dollar rupee you have seen in the past few days, and the volatile currency that is there. And policy, there is a lot of uncertainty, both in terms of what was put in the budget and the number of policies that are pending and still not seen daylight. So we got headwinds both from external and internal sources. When I was studying, I could go and take what in Hindi is called Kunji, or the guidebook, to be able to answer all questions. But in this kind of crisis, without the 2020 hindsight, it's going to be a treacherous kind of maneuver that we will have to make. Both global clues, which shows that the projected growth next year is lower than the current year at 3.5% versus 4%, and credit availability on one hand and volatility on the other hand is a cause for concern. In India, the RBI and the government has to manage the fund availability versus the inflation, and that makes it difficult for them. And funding for growth is still an issue, and the current account deficit is still an issue. So we have this kind of problem. So we can ask ourselves, is there no silver lining? Certainly there are many signals which could be positive. The US, for example, could clearly go in the positive trend, and the soft landing in Europe could also lead to many benefits for the global economy, which is today in an uncertain environment. Back to India, before that the oil prices are coming down, that's a good cue. In India, the middle class which has always been a very strong supporter and enabler of growth, as well as the strong fundamentals, and India Inc., which has always done well even in adverse time, should provide some bit of solace even with such a tough external environment. So coming to our financial, first I will talk about quarter's result. Just a word, because if you combine M&M and MVL together, it gives a very comprehensive view of the financials and the results, and therefore anything that I talk will be M&M plus MVML together. So the gross turnover, we touched first time at 10,000 crores turnover. This is a big milestone. We did 5,000 in F10, so in a span of about 8 quarters, we have doubled our revenue. And that's a big thing. That's a growth of 37%. And at a net level, 33% growth. The PAT at 911 crores is a growth of 36%, 35.5 to be exact, 36%. And that's a quarter growth which is in line and a little ahead of the revenue growth. OPM is at 12.1% this quarter versus 14% the previous year. And if you notice, the 2% difference is due to the numerator denominator effect. What basically it means is that if you pass 100% of the cost of material cost that we increase, that we get, still because of the numerator denominator effect, we will have an impact of 2%. Going to the full year result, we again have a milestone that we crossed 35,000 crores. And that is again a 33% growth versus previous year. At a PAT level, we are just shy of 3,000 crores, 2,997 to be exact, and that's a growth of 11.5%. And at a PAT level also, similarly we have a 12% growth versus previous year. OPM, 13.3% versus previous year, 15.4%. The reason is same as what I explained in the quarter. On the balance sheet, I'll just say that we had some increase in borrowings, which we have already talked about in the previous quarters. And in the asset side, the last line is important, the other assets. Because of the new classification of Schedule 6, the assets kind of doesn't come in the same way as you have seen in the previous quarter. However, in the schedules that you have and the stock exchange, you will see it by line item, inventory, receivables, etc. So it's much more clear. So, and if you have any clarity that I will give you, but overall, inventories or receivables are in line. Debt equity, we have 0.37 and total debt to EBITDA is 1. Interest coverage ratio, we have 14 times and debt service 7 times, and that gives a lot of headroom. Coming to a consolidated result, our gross revenue was 63,000 crores, and at a net level, it's little lower than 60,000 crores, 59,750 crores, which is a growth of 60%. SsangYong, which is coming to the fold for the first time, is a key ingredient of that. And on the PAT side, before minority interest, it's minus 3.6%, but after minority interest, it's a marginal growth of 2%. SsangYong, being the first year of operations, have contributed richly to the top line and has a negative impact on the bottom line. If I were to take it out for comparison's sake, then the net revenue at 48,000 crores is a growth of 28%. And when you take PAT after minority interest, it's a growth of 14.4%, or roughly 15% if you take minority before minority interest. So the revenues and the profits have grown half of what the revenue growth is. Next is that you ask the question, what are the group companies doing? So if I keep M&M plus MVML, which is the parent company, out, and then look at the results of all the subsidiary companies without these two, then the net revenue has actually grown 19% and the PAT has grown 36%. So the group companies have grown almost roughly double at profit level as compared to the revenue. So which means that the group companies or the companies that your SOTP calculation takes into account are starting to add value to the group. These are the top 4 PAT earners. These are all listed companies, the results you have seen. So how did we fare? If I take a 5-year period from 2008 to 2012, which is also the turbulent period, so to say, then we'll see that during these 5 years, we grew at a CAGR of about 27.5%. So over this 5-year period, we grew like that. And what is the profit growth against that? We grew profit at 28.4. So not only is our revenue profit growth in line with revenue, but it's a little ahead of even the revenue growth. If you look at the same figure, for the M&M as a total group, the revenue growth is 17.6% and the profit growth 22.4%. So even as a group, we have grown profits much higher than the revenue growth over a long period of 5 years. Next, if you look at comparison for the last 1 year versus Sensex, then you will see that the Sensex actually degrew by 16% during this period. I've taken 1st of April till mid-May before I took this slide out. But however, and we have degrown only by 8%, so we have performed much better than Sensex. So even if you take March as a comparative, then as of March, the Sensex degrew 10% and we were flat. So even there we are better than the Sensex. As when we talk about how good we are today in terms of strength of balance sheet, when we look at the growth that we have had and all that we have done. So even today, the debt equity ratio is only 0.37 and our debt EBITDA ratio is 1, giving a lot of headroom for us to take any more, for any activity that we have in future. So in nutshell, we have had strong revenue growth with leadership position in almost all segments that we participate. We have seen a little bit of dip in operating margins, but still, both for farm equipment segment as well as for auto, this represents best-in-class results. Pawan and his colleagues will talk about the operating results, and I will therefore not double that. However, I want to talk about some milestone in finance and M&A. In finance and M&A, we realize that the suppliers and vendors need a lot of support because the growth is very high and they need more money. So we have come with a scheme which allows them to get $1 billion to be able to fund growth. This we have started by leveraging group strength. We are halfway through, and next year we should be able to help them fund. We raised $150 million at benchmark prices. We are one notch up in the CRISIL rating to AA plus stable as compared to AA plus negative previously. And from an M&A perspective, MADPL merger, and we'll talk more about it today, and Swaraj Automotive Limited as a subsidiary got done this year, and we entered into micro irrigation with EPC Limited. We also supported the group in raising funds at very attractive rates in a tough environment. What drives us? And I think in all this, our right philosophy of accepting no limits, alternate thinking, and driving positive change along with our core value and core purpose drives us to perform ahead of the curve. And the trifecta of using the organizational culture, which I talked about, the RISE philosophy with good governance and sustainability, is the hallmark of our trifecta which leads us to us. And I believe you all recognized us. We won the Best M&A Award for Asia Pacific for our deals last year, and in the investor relation fraternity, you voted us as the top 5 IR companies in India. Thank you. And somebody who is not me. Thank you, Pawan. Yeah, I'll request Pawan to.
Good evening, friends. I'm going to request my colleagues, Mr. Raji and Praveen sir, to respectively talk about the farm equipment business and automotive.